Hi, I'm Trevor Austin, founder of Authentic Life Financial Planning. In this video, we're covering how early exercising your stock options can save you taxes. I do want to talk about early exercise stock options a little bit. Essentially, early exercise stock options allows you to invest in your company before the shares have actually vested. Now, it only applies to pre-IPO stock options, so it's not an option for public company stock options, but it is for private pre-IPO companies. And there's kind of two benefits to it, which basically is that the taxes are reduced when you early exercise versus exercising after the shares have vested. One thing to note is that you must file an 83B election to have the taxes accounted for now. And if you're going to early exercise options, if you have that option available to you, you need to be filing an 83B when you're doing this strategy. You have to be doing that because otherwise you're losing out on the only benefit really of an early exercise stock option. So let's look at the pros and cons, why you would do this. The two main pros are that you avoid a lot of tax, or potentially a lot of tax. Essentially, it allows you to have the bargain element be effectively zero when you exercise. Now, as we've talked about, the bargain element is a big part of the tax calculation, regardless of whether it's incentive stock options or non-qualified stock options. And so if we can have that be zero, it means you end up paying no taxes, regardless of option type. And the reason for that is because the fair market value and the exercise price are basically the same, or they should be the same if you're early exercising. One thing I don't know if I mentioned before, but really with this strategy, you really should be exercising when the shares are granted to you rather than when the shares vest in the future, if you're going to pursue a strategy like this. The second benefit that comes with early exercise stock options is that you're able to start the long-term capital gains clock. Again, taxation is a big part of stock option strategy and planning. And so if we can get that clock started earlier, there can be a lot of value to that, a lot of taxes avoided to that. Now, all this benefit isn't for, have no cons. There's actually a number of cons. Basically, you do have to exercise now. Given that it's private company, you generally have to pay the exercise cost in cash. So you have to bring cash to the table to make this happen. The other cons or the other risks, ultimately, is that if the shares do not vest, that money is gone. If the company does not grow, that money is gone. If there is no liquidity event in the future, that company is gone, or that money is gone. And additionally, if the company ends up going broke, or any of these things happen where the money is gone, there's no tax benefit to you to get anything back. You don't get to write it off as a worthless security. It's just that money's gone. And so you do have to be comfortable that you are paying, buying into a company that could be worthless, and there's really no way to get any benefit for you if that company does end up becoming worthless. Thanks for watching. If you found this video helpful, please like, subscribe, and drop a comment below with any questions or topics that you would like to see covered. Financial planning is all about creating the life you want. Let's build it together.